Welcome to the deep dive. Today, we're diving into a topic with massive global implications, something that keeps strategists and market analysts, well, absolutely glued to their screens. We're going to really unpack the potential repercussions of a U.S. war with Iran, specifically on the global energy industry, and, what it means for the American oil and gas sector.
It's a really critical subject, especially as our source material, like the insights from Chris Lehnes, a factoring specialist, keeps highlighting. Iran isn't just in the Middle East. Its location is geographically central, right in the heart of a region overflowing with the world's most abundant oil and gas. The mere hint of conflict there, it sends immediate shockwaves to the markets. It directly impacts, the financial side of energy trading.
Right. And that's why our mission today is to give you a shortcut, sort of, to being truly well-informed on this pretty complex issue. We're extracting the most important nuggets from the sources you've shared with us. We'll explore the immediate disruption, sure, but also the potential long-term structural shifts this kind of conflict could trigger. Get ready for some maybe surprising facts and a deep dive into what this could mean for all of us. So let's start at the beginning then. Why is this U.S.-Iran relationship, it seems regional, but why is it so utterly central to global energy?
Well, what's fascinating really is Iran's strategic location. It acts like a linchpin. Any serious conflict there, it directly impacts prices, obviously, but also supply chains, infrastructure, even the broader geopolitics of energy. Now, for the U.S. oil and gas industry, it's a multifaceted challenge. It affects, pretty much everything from upstream operations right down to the price you pay at the pump.
Okay. And our sources keep pointing to one place in particular, the Strait of Hormuz. This is where it gets really interesting, I think. For listeners who might not know, can you paint a picture? What is it and why is it so critical?
Absolutely. Imagine this narrow sea passage. At its narrowest point, it's just 21 miles wide. Tiny. But this passage, the Strait of Hormuz, handles approximately 20% of the world's petroleum.
20%?
Yeah, 20%. That includes exports from huge producers like Saudi Arabia, Iraq, Kuwait, UAE, and, of course, Iran itself. And Iran has, repeatedly threatened to close it or disrupt passage.
Right.
Now, even with the whole U.S. shale revolution making us less directly reliant on Middle Eastern oil for our own use, global oil prices are still highly sensitive to international supply and demand. Any disruption here, it means a sharp increase in oil prices. Wild, immediately.
Right. So even if we're producing a lot here, what does this all mean specifically for the U.S.? How does that global price shock hit home?
Well, yeah. While a lot of our production is domestic now, our refining, our petrochemical production, even our gasoline pricing, it's all globally integrated. So a war would cause just massive volatility in Brent and WTI prices.
Those are the benchmarks, right? Global and U.S.
Exactly. The global and U.S. crude benchmarks. It would spike insurance rates for oil tankers, trigger panic-driven speculative trading, and it could specifically affect the availability of certain types of crude, like the heavy crudes needed by many Gulf Coast refiners. We don't produce enough of that type domestically.
Okay. Markets hate uncertainty. That's the old saying. And war is pretty much the ultimate uncertainty. Can you give us some specifics on what we might see immediately, like at the pump?
Well, we've had glimpses. Remember when General Qasem Soleimani was killed in 2020? Oil prices jumped sharply, like overnight.
I remember that.
A full-blown war. It could easily push crude oil prices well above $100, maybe even $150 per barrel in the short term.
Wow, $150?
Yeah, and depending on how long it lasts, how intense it gets, gasoline prices could shoot past $6, maybe even $7 per gallon.
$6 or $7 a gallon?
It could happen. And this isn't just, numbers on a screen. It could lead to actual fuel rationing or states declaring emergency energy measures.
And the ripple effect. Beyond the gas station, what does that do to the wider economy?
Well, think about higher transportation costs. Higher shipping costs.
Yeah.
That leads to increased prices for almost everything. Food, goods, services.
Yeah.
It's an inflationary pressure cooker. And that kind of inflation could even force the Federal Reserve's hand on interest rates, potentially complicating any efforts at economic recovery.
We hear this term a lot, U.S. energy independence. Is that narrative entirely accurate in this kind of scenario? Does it shield us?
That's a really important question, and it gets into the nuance. Look, while America has become a net exporter of petroleum overall, which is huge, we still import specific grades of oil.
Yeah.
Especially those heavier crudes I mentioned that some refineries are configured for and that we don't produce enough of here. And critically, gasoline is priced on a global market. So even if our physical supply is mostly domestic, global turmoil still directly impacts market sentiment and prices right here at home. There's no real escaping that.
What about the Strategic Petroleum Reserve, the SPR, our emergency stash? Is that enough to cushion the blow?
The SPR holds currently around 350 to 400 million barrels.
Which sounds like a lot.
It is a lot, but while it could be used to try and stabilize prices, any withdrawals are temporary fixes. And the logistics, the physical movement of that much oil, that's complex. Plus, there's a market psychology aspect. Global traders might actually see using the FPR as a sign of, well, desperation.
Ah, like we're running out of options.
Exactly, which could paradoxically make market volatility even worse instead of calming it down.
Okay, so beyond prices, our sources also flag vulnerabilities in actual infrastructure. What are the key threats there, especially cyber threats?
Yeah, this is serious. Iran has demonstrated pretty significant cyber capabilities. They've targeted U.S. infrastructure before. In a war scenario, the oil and gas industry would be, frankly, a prime target. Think pipeline control systems. Remember the Colonial Pipeline incident?
Yeah, big disruption.
Right, imagine that. Or attacks on refineries, LNG export terminals, even data centers that are connected to the grid operations. These could cause widespread shutdowns, real chaos.
And physical attacks. Is that a realistic threat to U.S. assets?
It is, unfortunately. Iran could physically attack American oil infrastructure abroad. Think places like Iraq or the UAE, where there's a significant U.S. presence or joint ventures. This could mean drone attacks, missile strikes on production sites. They could also target U.S.-flagged tankers in international waters. All of this just adds layers of instability and drives up costs further.
Okay, let's look at the flip side for a moment. Do higher oil prices automatically mean a boom time for U.S. producers, especially shale?
Generally speaking, yes. Higher prices are definitely a benefit for U.S. producers, particularly shale companies. They become much more profitable. A sustained conflict driving up prices would likely trigger more drilling, probably a spike in oil and gas companies' share prices, maybe more jobs in places like Texas, North Dakota, New Mexico.
But it's not like they can just flip a switch and double production overnight, right?
Not at all. That's the key constraint. The industry would almost immediately run into bottlenecks. Equipment shortages, getting enough rigs, pipes, even the sand needed for fracking, and finding enough skilled labor.
Right.
Plus, you have permitting processes, potential environmental opposition. Those things don't just disappear in a crisis. They can still slow things down.
Yeah.
And, too much price volatility, even high volatility, can be tough. It makes planning difficult, especially for smaller producers or companies carrying a lot of debt. It also affects the midstream companies, the pipelines and storage.
Okay. Let's shift gears slightly to natural gas. The U.S. is now the world's top LNG exporter liquefied natural gas. How does a potential conflict affect that market?
That's a huge factor now. A war in the Middle East would likely drive up global demand for LNG quite significantly. European countries especially would be looking hard for alternatives to pipeline gas, seeking more secure supplies.
So, good for U.S. exporters.
Potentially, yes, in terms of demand, but it could also create real infrastructure bottlenecks at our own export terminals, mostly on the Gulf Coast. They might struggle to keep up. And that increased export demand could also drive up domestic natural gas prices here in the U.S., especially, during winter heating season.
What about Iran's own natural gas? They have massive reserves, don't they? Second largest, I think.
That's right, second largest in the world. Huge reserves. But because of sanctions, they currently play a pretty minimal role in the global gas market. They consume most of what they produce. A war would almost certainly push any potential reintegration of Iran into global energy markets, especially gas, back by decades. So it would essentially keep that massive potential supply off the market for the foreseeable future, further tightening things globally.
Okay, so in an energy emergency driven by conflict, what tends to happen with environmental rules and the push towards clean energy? Does that get sidelined?
History suggests it often does, unfortunately. In a perceived national security emergency focused on energy supply, the U.S. government might temporarily ease environmental restrictions.
Like on drilling or refining?
Exactly. To try and boost domestic fossil fuel production quickly. This can mean delays in implementing existing or planned clean energy policies, emissions regulations. You might even see moves to expand offshore drilling leases or open up more federal lands for extraction. Energy security tends to trump environmental goals in a crisis.
So is there a risk that a major prolonged oil crisis driven by war could seriously derail the clean energy transition?
It's a definite risk. If the crisis forces a deep, renewed reliance on fossil fuels just to keep the lights on and the economy moving, then longer-term clean energy targets could face real political headwinds. You might even see dormant coal or oil power plants brought back online. Maybe a slowdown in EV adoption if battery costs spike due to related supply chain issues. It forces a reprioritization.
How would investors react? Where would the money flow in this kind of scenario?
Well, you'd likely see a classic flight to safety, or perceived safety. Investors would probably shift towards assets like gold, government bonds, and of course oil itself. So valuations for major oil companies, maybe defense contractors too, they could increase significantly.
And renewables.
Conversely, renewable energy stocks might take a hit. If national budgets are suddenly reprioritized towards defense and immediate energy security, funding and focus could shift away from green initiatives, at least temporarily.
So a definite swing back towards traditional energy investment.
In the short to medium term, that seems likely. You'd probably see big players, sovereign wealth funds, pension funds, hedge funds, reallocating capital back towards fossil fuel assets. They might also start investing more heavily in just securing the existing energy infrastructure, both cyber and physical security, and probably reducing exposure to emerging markets anywhere near the conflict zone. Risk aversion takes over.
Looking beyond the immediate crisis phase, if something like this happened, how might U.S. energy policy fundamentally change long-term?
Good question. Post-conflict, you'd almost certainly see a major U.S. focus on resilience. That would likely mean prioritizing rebuilding strategic reserves, probably incentivizing more domestic energy storage, not just oil, but maybe gas and even electricity. Definitely more focus on domestic refining capacity and securing supply chains for critical minerals and battery components. Things needed for all kinds of energy, really.
So what kind of specific policies might we see emerge from that?
You could see things like new enhanced tax breaks, specifically for domestic producers. Maybe fast-tracked permitting processes, justified under national security exceptions, perhaps increased funding through the Department of Energy, but maybe redirected more towards fossil fuel R&D aimed at, say, boosting domestic extraction efficiency or developing cleaner ways to use existing resources.
Of course, this isn't just about the U.S. and Iran. How would a conflict ripple through other major players? OPEC, Russia, China.
Huge geopolitical implications. For OPEC, well, Iran is a key, if sometimes disruptive member. A war could really destabilize OPEC's internal cohesion. It might empower countries like Saudi Arabia and the UAE diplomatically within the group, but also cause serious friction over production quotas and strategy.
And Russia, would they see an advantage?
Russia might actually stand to benefit quite significantly. Increase global oil and gas prices, and potentially increase demand from Europe and Asia looking for non-Gulf sources.
Yep.
That could help them offset the impact of existing sanctions. It could give them, frankly, more leverage over energy-hungry European countries.
What about China? They're a massive energy importer.
China would be hugely impacted. They'd likely react by aggressively pursuing diversification, seeking more alternative suppliers, maybe in Africa, perhaps Venezuela, and certainly strengthening ties with Russia. But interestingly, perhaps paradoxically, it might also push China to accelerate its own investments in domestic energy, green energy, and EVs, precisely to reduce that long-term vulnerability to volatile global fossil fuel markets. Alongside all that, expect intense Chinese diplomacy with Gulf states to try and safeguard their existing energy imports.
So stepping back and looking at the really big picture, beyond the immediate shocks and policy shifts, could a conflict like this lead to a fundamental long-term reshaping of the entire global energy map?
Absolutely. I think it almost certainly would. A major conflict would likely spur the development of entirely new energy infrastructure, new pipelines, more LNG terminals, strategic corridors designed specifically to bypass the Persian Gulf region. You might see accelerated projects, say, connecting African gas fields to Europe, or much stronger U.S. energy partnerships with countries like India, maybe new oil routes opening up through Central Asia, bypassing the Chokepoint.
And this is where it gets really fascinating, potentially counterintuitive. Could a war, ironically, end up accelerating the clean energy transition in the long run?
It sounds odd, doesn't it? But yes, I think it's a real possibility. While the immediate reaction might be to double down on fossil fuels for security, a prolonged, painful crisis demonstrating the sheer vulnerability of that system could force governments globally to massively accelerate investment in alternatives. Think renewables like solar and wind, but also things like green hydrogen, not just for climate change anymore, but as a core national security imperative.
So the volatility itself becomes the driver.
Exactly. You might see huge emergency-level funding for things like grid-scale battery storage or building out hydrogen infrastructure, cutting through the usual red tape. Decentralized power, like local microgrids, could become way more attractive to reduce reliance on complex global supply chains. It fundamentally shifts the calculus towards prioritizing resilience and domestic control.
Given this whole landscape of potential impacts, all this volatility, what can energy firms actually do now? How should they prepare?
Preparation is key, even for unlikely scenarios. Energy firms really need to develop detailed contingency plans specifically for a major conflict scenario. This isn't just a risk assessment on paper. It means actively building redundancy into their supply chains, significantly beefing up cybersecurity defenses against sophisticated state-level attacks, and looking at specialized insurance or financial hedges against the risk of operational shutdowns caused by conflict.
So diversification seems like the name of the game.
Precisely. Companies that already have a genuinely diversified energy portfolio involved in oil, gas, but also significantly in renewables, they're likely to be much better positioned to weather this kind of storm. And interestingly, those more diversified firms might also become more attractive to long-term investors, particularly those focused on ESG factors, environmental, social governance.
Why is that?
Because that diversification signals resilience. It positions them as more future-ready, less vulnerable to the shocks inherent in relying solely on geopolitically sensitive fossil fuels. It's about long-term stability.
So, wrapping this up,
Yeah.
what does this all mean for you, our listener?
We've really gone deep today into the incredibly complex impacts of a potential U.S.-Iran conflict on energy, from gas prices jumping at the pump almost overnight to these huge potential long-term shifts in global energy policy, how we invest. The implications are just vast, and they're all connected.
Yeah, the sources we looked at really paint a clear picture. While there could be some short-term upsides for parts of the U.S. energy industry, higher prices, maybe more domestic investment.
The bigger, longer-term picture is one of significant uncertainty. It points to persistent inflationary pressures, widespread disruption in global markets, affecting pretty much everyone, producers and consumers alike, all around the world.
This deep dive, for me, really highlights just how deeply interconnected geopolitics and our everyday lives really are, especially through energy. As the world keeps navigating these complex relationships and, ever-growing energy demands, maybe the ultimate takeaway isn't just how fragile that global energy balance is, but maybe also how absolutely crucial things like strategic planning, real geopolitical awareness, and building resilient infrastructure truly are for everyone. So thinking beyond what we've explicitly discussed, what stands out to you as maybe the most critical, perhaps overlooked point for the energy industry to grapple with in a world that seems to be constantly navigating this tension between energy security and interdependence?
That's a great question to ponder. Perhaps it's the need to balance immediate needs with long-term strategic shifts faster than ever before. Until next time, keep digging deeper into the forces shaping our world.